Hi, my name is Joseph St. Rose. I am the president and proud co-founder of Fusion Commercial Real Estate Capital. Fusion Commercial Real Estate Capital has been around since 2005. We've been underwriting and originating commercial loans since then. I'm going to discuss three important metrics when it comes to analyzing a commercial real estate loan transaction. When analyzing commercial mortgage loans, there are three important measurements that we use to analyze any commercial property deal: net operating income, or NOI, capitalization rate, or cap rate, debt service coverage ratio, or DSCR. Commercial real estate can be viewed as a measurement of profitability based on cash flow. So net operating income is a calculation that is used to analyze the profitability of income generating real estate investments. NOI equals all revenue from the property less all operating expenses. NOI is what happens without looking at any debt service, capital expenditures, or depreciation. Accountants, when analyzing cash flow in other industries, refer to this number as EBITDA, or earnings before interest and taxes. When a bank is analyzing a loan to determine value and ability to repay their loan, they have certain carve-outs for vacancy, and they usually put a minimum property management expense. So if you look at our sheet or our income statement on this slide, the first line item is the potential gross income. Potential gross income really is the total of all actual leases on the property. So if you have 50 units, if all the leases are $1,000, your potential gross income is $50,000 for the month. That's not realistic in some cases, even though the landlord will put they're collecting all their rent. Sometimes people move, sometimes people just can't pay. There's many reasons why that rent roll would be affected. So when analyzing a commercial transaction, you want to take out a certain amount for vacancy, a vacancy allowance. Usually the standard for banks is 5% for residential units and 10% for commercial. If you look at our number, 66,000, that's between 5 and 10%. So when you see something like that, that's because it's a mixed use property. You have residential and commercial that we're analyzing. Once you take away your vacancy, you have the effective gross income. The effective gross income is what we look at to take away all our expenses. If you look at the first line item for expenses, is property management. Now, some of your borrowers will come in and say that they manage their own building. We don't have to put that number there, but we do, because when the bank analyzes this loan, they're looking at the fact that if they have to take over the property for any reason, they're not going to manage the property themselves. They're going to hire a property manager, and in the market right now, it's about 4% for property management. The other expenses: property insurance, fuel, water and sewer, common electricity, real estate taxes, repairs and maintenance. Those are pretty standard. So once you take away your expenses or operating expenses from your effective gross income, you're going to get your net operating income. And this number is very important. As we go through the next few slides, you're going to see it's really foundational for all of what goes on in analyzing property. We're looking at the cash flow, and we're hoping to have strong positive cash flow. What is a cap rate? It's our second metric that we look at to analyze, again, feasibility. It is a rate of interest or return expected based on the first year net operating income. It is used to derive an estimate of property value based on NOI, and most importantly, for the purposes of determining feasibility of a loan submission based on LTV considerations, loan to value considerations. Serves as a quick preliminary test for reasonableness of property value. So as a loan officer, when you are analyzing a file or analyzing a commercial transaction, it's good for you to understand the market and kind of know what the cap rates are in the market. If you can't necessarily find, if you don't know it in your head, there's resources that you can look at to help you determine cap rate. Cap rate is a ratio of net operating income to the current market value of the property. So as you do the math for this, you're going to be dividing your numerator, which is net operating income, by your denominator, which is the current market value of the property. So for calculating cap rate, there's different numbers, different moving parts. If you get the net operating income and you have a property value, you can easily do a quick calculation to determine if everything is kind of in line with the current market. So in this case, you have a net operating income of 694,000 and you have a property value of 16 million. When you do the math and divide it, you come up with 4.3%. In the 5 boroughs, the range is somewhere between 3 and 6. So depending on where this property is located and what the tenant mix is, will determine, more precisely what your cap rate is. In our second example, the borrower comes to you with a net operating income. You calculate the net operating income, and then you again know what the market should bear in whatever area the property is located. In this case, we're going to stick with 4.3%. That's going to be, when you do your calculation, the formula is a ratio of net operating income to cap rate. So once you take net operating income and you divide it by your cap rate, you'll get a value. In this case, the value is somewhere a little over $16 million. Our third metric is debt service coverage ratio. It is an underwriting metric that measures the amount of NOI available to cover the debt service. The available DSCR used by most banks is 1.25. In some deals, you might get as low as 1.2, and in some you might get as high as 1.3, but the average is somewhere around 1.25. This means that the available NOI must be 1.25 higher than the debt service of the proposed mortgage. In our example, if our DSCR is 1.25 and we have an NOI of $100,000, then our maximum annual debt service would be $80,000. Mathematically, if you're a mathematician, you could take the 1.25 and set it equal to your net operating income over your debt service. And what will happen there is that since you don't know what the debt service number is, you put an X for that. And since we don't know the value of X, we will need to rewrite the equation to isolate the variable. So X in this case would equal $80,000. Using a financial calculator, we can see how different mortgage rates would affect the amount of loan that can be obtained. In our example, $80,000 is the maximum annual debt service. So a monthly debt service would be approximately $6,667. Dividing that 80,000 by 12 months would give you that number. Below, we can see what the effect of changing loan terms can have on the maximum loan offer from the bank. Your inputs to your financial calculator would be as follows. So you take your financial calculator, you would plug in for the period N. In this case, we have 360 periods, which means we have a 30-year mortgage at 6%. We place it in the I, interest. You put for your payment, you put a negative 6667 and your future value of 0, and then you would come up with 1,112,000. That would be the loan amount that the bank will lend in this scenario. If you look at the next one, but right below, 360 months again, but now your interest rate went up to 7%. With the higher interest rate, it lowers the amount of mortgage that you can get. In this case, it's $1 million you can get based on calculation. And finally, another look at shortening the period, the loan term, to 25 years or 300 months. At 7%, your loan went even smaller than 943,246. So these three metrics are very important in trying to understand and analyze what commercial mortgages or what a property would qualify for in terms of commercial mortgage. Right here, I would ask you to pause your video, and then once you pause the video, take a look, read the problem, and see in your mind if you can kind of figure out what can be done with this particular mortgage in terms of how much mortgage will be gotten and would we meet the needs of the borrower. Okay, so let's read it together. An investment prop company is looking to leverage a building to pay off an existing mortgage and take cash out to improve the property. They advise that the property value is $20 million with a gross annual rent roll of $973.92. After the bank moves an allowance for vacancies and operating expenses, the NOI is actually $694,854.50. The client wants to pay off an existing mortgage of $8 million and take out $2.5 million to upgrade the property. The property is in Lower Manhattan and the cap rate is 4.3%. So the first step I would take is I would look and see what the real approximate value of the property is by looking at the cap rate and NOI. Knowing the area, the cap rate for this particular property would be 4.3%, and we know what the net operating income is. It's $694,854.50. Once you do your calculations, you'll see that the value really is only $16,159,407, which is shorter than what the borrower told you, which is probably no surprise. Everybody thinks their property is worth more than it is. The next step would be the loan program that this client qualifies for has the following terms. So there's terms that we get from our lender to let us know what they're willing to do based on LTV. Then you get your loan term. So in this case, your LTV is 60%. Your loan terms are 5 years with a 5-year renewal option, 4.5% interest rate to be set at loan commitment, and loan payable in constant monthly payments based on a 30-year amortization. Based on the above terms, the maximum loan amount available before calculating for DSCR would be $9,695,644.20. That's 60% of what we derived from our cap rate. But now, let's look and see what happens when DSCR is applied. In step 3, loan amount based on LTV of 60% is actually $9,695,644.20. With an interest rate of 4.5% and an amortization term of 30 years, the annual debt service for that particular loan is $589,516.86. With DSCR being 1.25, we've come up a little short when we do our calculation. Doing our calculation, we're now looking at 1.18. So since the DSCR has to be at least 1.25 or 125% of the loan amount would have to be lowered. Based on the above, the maximum debt service would be $555,883.60. That's based on the fact that we need to be at 1.25. So the highest loan amount would be $9,142,000. So where does this leave us? Where it leaves us is that in our scenario, the client is looking to pay off an existing mortgage of $8 million and take out $2.5 million to upgrade the property. The client, in addition to the $10,500,000 in financing that they will need, they also will have to pay closing costs of approximately $400,000. This is way over what they can get based on our calculations, right? Because after closing costs and loan payoffs, they'll only have approximately $742,000 to upgrade the property. So this is where you have to get involved in a deeper cash flow discussion to see what kind of arrangements can be made either through regular cash flow or perhaps through credit arrangements with the contracting firm to see if this deal is still something with which the client wishes to proceed.